When it comes to retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated like a number. This is your retirement. So it's time to think differently. And you're in luck because you found the Retire Your Way podcast with Dave Lopez, founder and managing member of ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and the ILG Financial team focus on building one retirement plan at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hat and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now. Coming to you from the ILG Financial Studios, this is Retire Your Way, the podcast that gives you straight talk and honest answers and insight that you need to help achieve your financial goals through smart investing and careful planning. My name's Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and the solid advice come from Dave Lopez, managing member and owner of ILG Financial. How you doing these days, Dave?
I'm doing well. All is healthy. The family's good, and sure looking forward to this new series we've got started together. I'm going to enjoy doing it, and I'm going to enjoy doing it with you, Jeff.
Well, likewise too, Dave. Always good to talk to you here. I learned so much, and I know our listeners learn a lot too. So, Dave, let's continue our series here on the 5 economic cracks in America's foundation. This is part 2 of our series. But first, Dave, let's recap some of the indicators that we talked about last week. And the first one was that the stock market is really nearing some all-time highs.
Yeah, so the first economic crack, and we spent the first podcast last week on this, was what are some of the market indicators that we can look at that might be pointing, just like weather vanes, to the idea that the market is well overdue for an economic correction. And we really looked at 4 of them, if I'm not mistaken. The first one was the Buffett indicator. And if you recall, the Buffett indicator was called that because Warren Buffett said it's the best possible single measure of where valuations stand at any given minute. And all it is it's the total value of U.S. stocks compared to the total value of our United States gross domestic product. And usually, gross domestic product is more than the value of the stocks, which would kind of make sense. But only in 2 times in history have we seen stocks valued more than the gross domestic product. And it happened in 1999, the dot-com bubble crashed about 47 or 48%. And it happened again, Jeff, in 2007, and what we saw again was about a 58% pullback in the markets with the mortgage debacle and the Great Recession. And the interesting aside we told last week with that was, even though Buffett talks about buying and holding over the long term and maybe just buying the broad U.S. economic index or the global indexes, while he's telling us to do that with our savings, he's moved about $116 billion out of the market and into cash and cash equivalents, and he's hinted that he's probably going to move up to $150 billion. So we've got this dichotomy between what the average Joe is being told to do, the buy and hold model, and what the wealthy are actually doing when they're looking at these weather vanes or market indicators pointing to the fact that we're overdue for a correction. So the first one is the Buffett indicator, and it's pointing to a major economic correction on the immediate horizon.
So Warren is saying, do as I say, but not as I do. And I realize, and we talked about this last week, is that Warren Buffett certainly is a different sort of investor than you and I, right?
He is, and what we do isn't necessarily going to be just what he does. But like anything, it's always good when anyone's giving advice, take a look at what they're doing in addition to, and maybe more importantly, instead of what they're saying. So my point is, if you value his opinion and he's moving huge volumes of his assets to cash, it's just nothing more than an indicator that you should start to question, why is that happening, and does that affect me, and should I consider that, or should I stay with the old buy and hold strategy? Now that's just one of the indexes, right? We talked about the other index, which is pointing in the exact same direction, is called the Shiller price to earnings ratio, and it's just the ratio between the price of a stock and the earnings it generates in a given year. So usually the price to earnings ratio, the historical average of that ratio, Jeff, is 16. And all that means is, based on the price you're paying for that stock and the earnings that company spits out, it would take about 16 years of earnings to pay you back for the stock. Well, that's the historic average. Right now, the average price to earnings ratio for stocks is, get this, 33, over twice as high as the normal average. That is a huge negative market indicator. And just like we talked about with the Buffett indicator, there's only 2 times that we've seen the Buffett indicator point in this direction. It was 2007 and 1999. And sure enough, there's 3 times the Shiller index has pointed to a market correction that the P&E has been this high. 2 of them, just like the Buffett indicator, 2007 and 1999. The third one is 1929, and we saw about a 90% correction in the stock market in 1929. So you've got, right off the bat, 2 market indicators. I think of them as weather vanes, both pointing in the same direction. And that direction is stocks are overpriced, not even counting the coronavirus and the implications from the economic pullback. Now, you add the coronavirus to that, and we've got a dangerous situation for folks that are in the buy and hold model.
Boy, it sure sounds that way, Dave. So in a healthy market, your P&E ratio is about 16 years for a stock's earnings to equal its price. And today, 33 years. That is amazing. Certainly a little bit disturbing there. We're talking about some market indicators that indicate that maybe there are some cracks in America's economic foundation. Another one that we talked about last week, Dave, and let's touch on this a little bit, is margin debt.
Yeah, margin debt is really just a ratio of how much money is being borrowed to invest in stocks and things like that. So usually that margin debt doesn't breach more than 140 or 150%. In fact, the first 2 times that margin debt did breach 150%, and all that means is that the margin, the amount of money being borrowed, has grown faster than the stock market price. The first 2 times in history that it breached 150% was, you guessed it, 2000, the dot-com bubble burst, and 2007, the Great Recession. And both times, the stock market collapsed roughly 50%. There's one other time, by the way. When the margin debt breached 150% in 2014, the stock market did not crash. It just kept going up. Now, that's not necessarily a good thing, because what that means is where we are now, 6 years after 2014 and 2020, we're now at a position where the margin debt is the highest level of margin debt in United States history. So let that sink in. Never before has the amount of money being borrowed to invest in the stock market been higher than it is now. And that means when the market starts to pull back, and these folks have borrowed money to invest in the market, their losses are going to be severe and quick. And the only way out of that is to try to sell quick. So that's what's called panic selling. And that's when you see huge market drops very quickly, incidentally, like we saw in March.
Dave, the last indicator that we talked about last week reminds me of if you have ever sold something on eBay. People put things on eBay and then themselves or their friends may artificially bid up the price of what they're selling so they can create a higher value than what something is really worth. And it is illegal. It's called shill bidding on eBay. The same sort of principle applies to something called stock buybacks, right?
Boy, you're exactly right. And what's interesting was after the 1929 market crash, stock buybacks by companies was made illegal also. Now, that's been changed since then, and it's legal again. And the result is that, as you would guess, just like in 29, market prices went through the roof. Stock buybacks are when companies borrow money, and instead of using that money to expand their company and grow their company, they just take that money and buy their own stock, which artificially makes the stock price go up. And what that means is when you and I are looking at a company that we like, we see the stock price going up. We think that means that everything's rosy because everyone else believes the market's going up, but it's being artificially propped up. And when interest rates start to go up, these companies are going to have to pay this debt for all their borrowed money on the stocks, and that could result, like it did in 1929, in a huge economic calamity, especially for the market. So the takeaway from the stock buyback program is this. Companies are buying their own shares on the open market. That's manipulating the share price by creating an artificial demand for the stock. It's referred to as financial engineering, and that's usually never a good term, financial engineering. These companies are borrowing money to buy back their shares, so corporate debt, as a result, is at its highest level that it's ever been, Jeff. Highest level of corporate debt in U.S. history. This is not sustainable. The moment these companies stop buying their own shares, we could see the stock market drop considerably. And corporate stock buybacks are, historically looking back, what has been agreed is what ignited the Great Depression.
Interesting concept, Dave. Thanks for that. This is part 2 of our 3-part series on the 5 economic cracks in America's financial foundation. We want to talk about what to do about this, Dave, but right now I want to ask a little question. You know, this seems to be the time of unprecedented, uncertain, unbelievable. Those are some words that have become part of our new normal, and if you're retired, about to retire, or lost your job, you can add unfair to that list. But at ILG Financial, you know, we see a lot differently. For us, it means unyielding, uncompromising, and most of all, unbreakable. It defines who we are as a nation, a community, and our commitment to help guide you through this time. We were here before the crisis, and we're going to be here after it's a distant memory. And most importantly, we're here right now to help you in any way that we can. Doesn't matter if you're a current client or not. If you have questions about your financial plan, we're here to help provide the answers. You can watch one of our webinars or download one of our books or guides. And if you just need reassurance of a second opinion, we're here for that too. You can contact us through the red footer on our website, ilgfinancial.com. Someone will get right back to you within 24 hours. Or, of course, you can always call the office anytime, 540-720-5656, 540-720-5656. Dave, we've been talking about these indicators that point to economic cracks in America's foundation. So I guess the big question here, one is, what are we going to do about this?
Boy, that's the big one, isn't it? And the answer, we've hinted at this in the last couple podcasts. Remember, there is no one answer that fits everybody. It really depends on your goals with your money, your timeline, and your risk tolerance. But what it does tell us is, and this is one rule of thumb I would say to apply to anybody listening, if you believe these market indicators and you believe that the fact that all 4 of them, like weather vanes, are pointing in the same direction, Jeff, and that direction is we are not just overdue for a market correction and a pullback, but we are overdue for a significant market correction and a pullback. Then the question would be, should I buy and hold and just leave it and not look at it? Or should I maybe move to safety? And there's several ways we can do that until this economic tsunami passes. Well, the answer is different for everybody, but one of the things I would suggest is, Warren Buffett says, famously, if you're not willing to be in the market and leave your money untouched, no matter what, for 10 years minimum, you have no business being in the market for 10 minutes. Now, I subscribe to that. The challenge is he says it, and to be fair to him, he's very outspoken about that. Yet then folks are told to put their 401ks in the market, even when folks telling them that know that they're going to need that money in less than 10 years. Never before have I felt it's more important to listen to that axiom and ask yourself, the money you've got in the market, Jeff, right now, you need to be willing, if the market corrected tomorrow, to not worry and just leave it for a minimum of 10 years. Because here's some of the data you want to be aware of. A lot of folks think, I'll just leave it because the market will pop right back. And they tell me, look, when the dot-com bubble burst, my 401k was even in about 3 to 4 years. Well, that's usually, in fact, almost always when we've looked at those, not been the case. The reason they were back to even so quick is they were actively working and contributing to their 401ks, right? So when you actually go back, and we've done this for clients, and you do the math, and we said, wait a minute, let's just go back and subtract all of these contributions you made, right after the 2000 dot-com bubble burst, then their numbers line up pretty much with the actual market. And the numbers in the market showed after the dot-com bubble burst, it took 8 years, all the way to 2008, for you to get even if you had just done the buy and hold. Now, that's even misleading, because what we know is if you had spent 8 years waiting to get even, and you said, thank goodness, I have $100,000 in my 401k, I listened to everybody with the buy and hold, I didn't touch the money, and here we are 8 years later, and I'm right where I started at $100,000. Well, no sooner did that happen than we had the Great Recession hit, and your $100,000 lost another 56%, and now you're back down to about $44,000. And you would have had to wait after the Great Recession another 5 years just to get back to your $100,000. So that's a 13-year buy and hold period just to earn nothing. Now, that's okay, possibly, if you're 20 or 30 years old, because that whole time, one, you didn't need the 401k. But the second point is you were actually still contributing, weren't you, Jeff? So you're literally buying into the market at all-time lows. So that's what we call dollar cost averaging. It's a wonderful strategy if you're in your 20s or 30s, or possibly in your 40s if you're planning to work to your mid and late 60s. But if you're at 55 or up, in retirement or within 5 or 10 years of retirement, all the rules for investing change, Jeff. And now the buy and hold, we've got to start asking ourselves, is it possible that if this market corrects today, that it could be 10 years or more before I get even? We're not talking about making money now. We're talking about getting back to where you are today. And the data unequivocally says not only could it take 10 years, it could take more than 10 years. I just showed you from 2000 to 2013, if you had done a buy and hold, not counting dividends, you'd have been even, right? Doesn't count dividends, but it also doesn't count taxes and fees. But even with dividends, you're talking about paltry growth for a 13-year window. Now, if you retire and you're 65 and that happens, what that means is 13 years, you're 78. You're almost 80 years old just to get back to where you were when you retired at 65. If you're not willing to do that, to leave that money untouched, I would suggest we need to discuss other options for investing that bucket. Now, that's just one example, right? You can look at the Dow Jones from 1964 to 1982. Or even a couple years after that, 66 to 82, you're talking about between 16 and 18 years for the Dow Jones to end exactly where it started. 18 years of no gains. So at 65, now you're talking about, what's that, about 84? 84 before you not make a lot of money, but just get even. So what we're seeing here, we're shedding light on the fact that buy and hold is a great vehicle, in my opinion, if you're in your 20s, 30s, and early 40s, because you can afford to leave your 401k or your IRA untouched for 15 or 20 years, and all the while, if the market is down, be buying more stock at a discount. But if you're at the age where you're within 5 or 10 years from retirement, or you're in retirement and you're not contributing anymore, then we're just talking about leaving your money untouched just to get even. So we see the Great Recession is one example, 2000 to 2013, 13 years of no returns. I just showed you 64 to 82, about 18 years of relatively no gains whatsoever. And then, of course, with the Great Depression, what we saw is the market dropped about 90%, and it took, depending on your measurement, 24 to 26 years to get even. 24 to 26 years. For many people, that's their entire retirement of not touching their money just to get back to where they were. So there's the challenge. And it sheds light on the fact that buy and hold is a great strategy in certain situations. But it is not, in my opinion, a good strategy if you want to use this money in 10 years or less. Now, the good news is there are other strategies, but most of them are all hinged on making some correction before we lose 30 or 40%.
That's Dave Lopez, managing member and owner of ILG Financial, and we've been talking about indicators of economic cracks in America's foundation. And as Dave said, everything depends upon your goals, your timeline, and your risk insofar as what to do. If you have specific questions for Dave, and maybe you're a little bit closer to retirement or in retirement, you want to know what to do, call Dave there at ILG Financial, 540-720-5656. And of course, the website is ilgfinancial.com. Dave, this was the second part of our series here in these economic cracks, and, this has been so interesting. I don't know. We may need to expand this series to a few more than 3 episodes. We'll wait and see. But we do invite people to join us again next week for ILG Financial's Retire Your Way with Dave Lopez when we continue our conversation. For Dave Lopez, I'm Jeff Shea. Thanks for listening. Have yourselves a great day, won't you? We'll talk to you again next time with another edition of Retire Your Way.
The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and not necessarily represent the views of AlphaStar Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through AlphaStar Capital Management, LLC, an SEC-registered investment investment advisor. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. AlphaStar and ILG Financial LLC are independent entities.